Hi. When we talk about risk in finance, most people instantly think of losses, fear, or uncertainty. But here's the twist: risk isn't always the villain of the story. It has two sides. On one hand, downside risk signals potential losses. On the other, upside risk opens doors to growth and opportunity. Mastering both sides is what turns risk into a powerful tool for long-term success. Every bank aspires to fulfill its strategic vision, but not every journey unfolds as planned. Falling short of strategic goals often reflects downside risk. The chance that unexpected events erode value through financial losses, missed targets, reputational harm, or operational disruptions. This is the darker side of uncertainty, requiring constant vigilance and disciplined management. For bankers, investors, and businesses alike, downside risk is the source of restless nights, underscoring how fragile stability remains in today's financial landscape. Downside risk can be illustrated through a recession scenario. When borrower defaults rise in a bank's loan portfolio, it reflects the adverse potential for credit losses that weaken capital strength, reduce profitability, and threaten overall institutional stability. But there's another side, upside risk. This refers to the chance that actual outcomes turn out better than expected, higher returns, stronger growth, or bigger opportunities. Upside risk is an opportunity because it reflects the potential for outcomes to exceed expectations. Unlike downside risk, which threatens losses, upside risk opens doors for growth, innovation, and competitive advantage. In banking and business, recognizing upside risk helps leaders seize favorable shifts, strengthen resilience, and unlock value while managing uncertainty with balance and foresight. Imagine you invested in technology stocks expecting a 10% return, but markets rallied and delivered 25%. That extra gain is upside risk. It's risk, because it's uncertain, but this time, in your favor. In risk management, it is vital to consider both downside risk and upside risks. Controlling downside risk shields the bank from potential shocks, whereas identifying upside risk enables the bank to capture opportunities and strengthen performance when conditions shift favorably. Effective risk managers go beyond loss prevention. They design frameworks to harness upside potential, whether by diversifying portfolios, stress testing adverse scenarios, or aligning strategies with sustainable, long-term growth opportunities.